Welcome to Mr. Yang, your daily dose of financial insights to help you see further. Have you ever noticed this? You pick up your phone, check the US stock market, gold, or even Bitcoin, and you see the same word everywhere: all-time highs. Almost everything you thought was worth investing in has become so expensive that it's hard to take the plunge. It can feel really conflicting. On one hand, everyone around you, every media expert, is telling a story of prosperity. The AI revolution is booming, technology is exploding, and markets are soaring. You feel like if you don't jump in now, you'll miss an entire era. But on the other hand, if you look a little deeper at the analysis, you'll hear a very different, anxious, even panicked perspective. They point to America's $38 trillion national debt, the enormous interest payments, and ask, is the dollar about to collapse? Trade wars are ongoing. The economy is struggling. Isn't this bubble about to burst? These people aren't waiting for a mere market correction. They're waiting for a full-blown crash, a 40% or even 50% systemic collapse. So when you're caught in the middle, what should you fear more? Missing out on opportunities or losing everything by entering the market at the wrong time? Are you waiting for a bottom that will never come? Or are you about to jump straight into a fire pit as a bag holder? If this resonates with how you feel right now, congratulations, you're thinking clearly. This video is made for you. Together, we'll analyze the macroeconomic trends and investment strategies from 2025 to 2030, aiming to give you the closest thing to the truth. Here's the conclusion up front. My answer is neither run away nor blindly charge in. I don't believe the market will experience the kind of systemic collapse you fear. The outlook is neutral to bullish. This means we can no longer rely on the old, simple mindset of buy the dip after a crash or sell at the peak of a bubble. We've entered a game with entirely new rules. Today, we're going to break down those rules completely. I'll build a 3-layer macro analysis framework to help you understand why we're in this era of everything being expensive. Then, based on this framework, I'll provide a concrete, actionable investment strategy. Especially if you're holding cash right now, but don't know whether or when to enter the market, this could be the most important video for you in the next 5 years. Let's dive in. To know what to do in the future, we first need to understand what's happening now. Why are assets hitting record highs across the board? Let's do a thought experiment. Imagine you live on a small island. The island has exactly 100 houses, 100 cars, and 100 small shops. The total money circulating on the island is $1 million. On average, the price of each house, each car, and each shop fluctuates around a certain mean. Now, imagine the island's central bank drops more money from a helicopter, printing another $1 million and distributing it to everyone. The number of houses, cars, and shops hasn't changed, but everyone now has twice as much cash. What happens? The prices of all assets inevitably rise, simply because there's more money chasing the same number of assets. This is the fundamental reason global asset prices rose from 2020 to 2025. The global money supply increased dramatically in a very short time. What we saw wasn't a universal increase in asset value. It was more money being used to measure that value. In other words, the money itself became diluted. Looking ahead to 2025 to 2030, this trend won't stop. It's expected to continue. By 2030, the US national debt is projected to grow from $38 trillion in 2025 to $50 trillion. That means over the next 5 years, the US government alone will expand the money supply by roughly 6% per year on average. Just like our little island example, this will keep pushing asset prices higher. The central bank has announced that over the next 5 years, it will steadily inject an additional 6% of money into our island each year. This means that all assets, even if they do nothing, will automatically increase in value when measured in money. That 6% sets the backdrop for understanding all investments. We are living in an era where rising tides lift all boats. As the money supply continues to rise, holding cash in your hand is effectively losing value over time. This is the first layer. Money printing is the fundamental driver of rising asset prices. At this point, you might be thinking, I get it, it's just inflation. I should convert all my cash into assets, buy stocks, gold, Bitcoin, close my eyes and buy because everything will go up. If that's your mindset, you're stuck in the first layer and about to fall into the second trap. Just because the overall tide rises doesn't mean every boat rises equally. Some are luxury yachts, others are leaky rafts. This brings us to the second layer of our framework. Against the backdrop of rising money, we must start distinguishing between price increases driven by real value and those driven by bubbles. Let me give you a metaphor. Imagine two types of boats floating on the rising tide. The first is a luxury yacht, expensive because it's packed with advanced technology and a powerful engine. Its price goes up partly because the tide rises, but also because its intrinsic value is genuinely increasing. The second type is a bubble raft. It may look large and its price is rising, but up close, it's just a bundle of rotten wood stuffed with foam. Its only value is that people think someone else will pay more for it tomorrow. That's a bubble. From 2025 to 2030, our market will have both types. Today's record highs include luxury yachts, like truly profitable tech companies, but are mixed with bubble rafts, like companies that only survive on hype with no real profit potential. The flood of money lifts them all, but when the tide recedes or a big wave hits, the bubble rafts collapse instantly. Our second task is to identify these bubbles and avoid the bubble rafts. You can't just jump on any boat because the tide is rising. But then the question arises, how do you know which boats are luxury yachts and which are bubble rafts? This leads us to the most important concept in our framework, the K-shaped economy. Look at the right side of the K. It shares a common starting point. From there, it splits into two paths, one rising, one falling. This perfectly depicts the future of our economy. It's no longer moving together, rising and falling in unison. Instead, it is undergoing a massive, irreversible divergence. One of the clearest examples of the upward branch of the K-shaped economy is AI-focused technology companies. Governments and global conglomerates are carrying out the largest wave of capital expenditure in human history, and almost all of that money is flowing into areas like AI and semiconductors. This isn't retail investors speculating in stocks. This is governments and giants betting on the future. They're deploying hundreds of billions, even trillions of real dollars to build an intelligent society. These sectors are projected to deliver compound annual growth rates of over 20% in the coming years. There's a clear piece of evidence for this. If you remove AI-related companies from US economic growth data, the remaining growth rate is actually negative. That's the upward branch of the K-shape. They are the engines. They are the source of growth. The downward branch of the K includes traditional industries that can't adapt to the new era, or sectors being heavily squeezed by macroeconomic pressures. They look like the downward sloping line of the K. Even in a flood of money printing, they may slowly float upward, but their speed is nowhere near that of the luxury yachts. In relative terms, they're actually sinking. They're being left behind by the times. At this point, you might say, I understand all of this. I know I should buy K-shaped upward assets. But then you look at the prices. They've already gone through the roof. If I buy now, won't I just be the person standing guard at the very top of the K-shaped upward branch? This is the core question everyone faces in 2025. To answer this, we first need to define a concept called naked risk exposure. If you listen to everything I've said so far, feel completely convinced, then open your account and throw all your savings, maybe even with leverage, into the stocks that have risen the most. That is naked risk exposure. You need to understand that while markets rise over the long term, short-term volatility and risk are unavoidable. If you're fully exposed to risk, a single misstep, like a 20% market correction, can wipe you out completely. So from 2025 to 2030, our core strategy isn't about whether to buy, but how to buy. We must manage risk. For ordinary investors, these 3 risk management strategies are the most effective and fundamental. Please remember them. They matter more than which stock you choose. Risk management strategy number 1. Never use leverage. This is the first rule, and it's an absolute rule. Any small fluctuation gets infinitely magnified by leverage. When others are down 10% with just a scratch, you might already be wiped out if you're leveraged. In a K-shaped market, surviving matters more than anything else. Risk management strategy number 2. Maintain a reasonable balance between cash and investments. This is the core of the core. If you have 1 million, what should you do? Naked risk exposure means putting all 1 million into the market at once. A rational investor keeps a reasonable cash position. That ratio could be 30 to 70 or 20 to 80. Adjust it based on your own risk tolerance. But the principle is the same. Always keep at least 6 months of emergency funds. This is the bottom line. And holding cash isn't just about risk management. It's not idle money. It's money waiting for a mission. Markets never go up forever. Even in a neutral to bullish trend, pullbacks are inevitable. It could be a bad earnings report or a sudden black swan event where the market drops 10%, 15%, or even 20%. When those luxury yachts you've been dreaming of go on sale, when others are panic selling, if you have cash, you can buy more high-quality assets at lower prices. You turn the biggest downside risk in the market into your biggest opportunity to add positions. This cash is the ballast that carries you through the next 5 years of volatility. It ensures you always have ammunition and confidence. Risk management strategy number 3. Dollar cost averaging. You might say, I don't have $1 million. I only save a few thousand each month. That's perfect. Your situation is naturally suited to one of the most powerful risk management tools there is, dollar cost averaging. And the best targets for this strategy are broad market index funds like the S&P 500 or the NASDAQ 100. Buying an index is like buying all the luxury yachts in the K-shaped upward branch at once. It automatically eliminates the bubble rafts that start leaking. You don't need to guess who the next NVIDIA will be. You just need to believe in the K-shaped upward trend itself. And that's enough. Now that you understand risk management strategies, before you set off, I need to help you clear one last psychological obstacle: the most extreme market panic narratives we mentioned at the beginning. You will definitely see these arguments online, and they can shake your confidence. The most common ones go like this. US debt has hit $38 trillion and is about to collapse. The dollar will turn into worthless paper, and gold or Bitcoin will replace all fiat currencies, which will go to zero. These claims sound terrifying and extreme, but they're wrong because they lack one fundamental thing: a holistic understanding of the financial system. Let's break them down one by one. Panic argument number 1. Will the US dollar completely collapse? Let's think this through. What would a dollar collapse actually mean? First, around 70% of global trade is settled in US dollars. If the dollar collapses, it's like the main pipeline of global trade exploding. Commercial activity around the world would grind to a halt almost instantly. Second, who holds that $38 trillion in US debt? Europe? China? Japan? Your bank's wealth management products? Your company's pension funds? If the dollar collapses and those debts suddenly go to zero, then the balance sheets of all those countries and institutions would be wiped out. Their wealth would simply disappear. Do you see it now? The dollar stopped being just America's currency a long time ago. It is the operating system of the global financial system. That operating system can be patched. It can be upgraded. It can even run slowly and feel clunky, but it cannot be uninstalled because it's too deeply integrated with everyone else. And that leads us to the second panic argument. Will assets go to zero? Extreme pessimists love black and white thinking. They'll say stocks are a bubble and will go to zero, fiat money is worthless paper and will go to zero, and only gold or Bitcoin is the ultimate answer. This is a profound misunderstanding of finance. In a healthy financial system, capital behaves like water. It's always flowing, moving out of overvalued assets and into undervalued ones. When stocks become too expensive and fear rises, money flows into safe havens like gold and bonds. When bond yields get too low and no longer seem attractive, capital flows back into profit-generating stocks. When interest rates on fiat currency are high enough, people will even sell stocks and gold and move back into cash, parking it in the bank. Do you see what's happening? Stocks, gold, fiat currency, and Bitcoin are all essential reservoirs in this larger system. Capital simply rotates among them, searching for the safest and most efficient place at any given time. There is no fundamental consensus that assets will completely go to zero. So please, stay away from this kind of black and white panic thinking. The dollar will not collapse. Stocks will not go to zero. Bitcoin will not go to zero. Gold will not replace everything. The world is far more resilient than you think. So from 2025 to 2030, these critical 5 years are no longer a test of your ability to predict a crash. That epic 50% collapse everyone is waiting for may never arrive in the way you imagine. And remember, waiting itself is a risk. By waiting for the perfect bottom, you take on the risk of missing out. What you miss may not just be a price. You may miss the entire structural upside of K-shaped divergence. Over the next 5 years, what the market will truly test is your psychological resilience. Can you stay calm and deploy your cash reserves when panic is everywhere and others are cutting losses? Can you stay disciplined when the market is euphoric and everyone is shouting all in, refusing to use leverage, maintaining cash positions, and avoiding naked risk exposure? Are you willing to keep believing in the value of high-quality assets, even when prices already look expensive, and accumulate them through dollar-cost averaging? That is the real battleground of investing in the next 5 years. We are not entering an era defined by record highs. We are entering an era of massive divergence and ruthless selection. Financial markets are using high prices to identify the true K-shaped winners and brutal volatility to filter out the investors who truly have discipline. Your job is not to predict the storm. Your job is to put on your gear before it arrives, make sure your ship is the strongest luxury yacht, and then sail through the cycle to the other side. A little financial insight every day to help you see further. If this video gave you value, don't forget to like, subscribe, and share. Leave your thoughts in the comments, and I'll see you in the next one.